Chapter 3 now, part 2, the accounting information system. In the first part, we did the first 4 and 5 actually study objectives. We're going to revisit 5, 6, and we're going to have 7 and 8. Now, completely ignore 9. We'll do that in another time. Okay, so here we go. A review, the journal. The journal is where we record business transactions. Recall a transaction is an exchange. It affects 2 accounts. We record the effect on each one of those accounts in the journal, and we do it in chronological order, which means by date and time. Okay? And we record it in 2 places. And in that way, if we catch a mistake, if we make a mistake, each journal entry has to have 1 debit and 1 credit, or at least the debits equal the credits, so we can spot our mistake very easily. Journalizing, for example, we have these 3 journal entries. Sierra issued common stock for $10,000. How do we record that? Well, cash goes up and common stock goes up. We always record the debit first, and you notice we record it very close to the line, and here, right next to the line. Debit, cash, right here. And then we're going to credit, and we indent. Indent means we move it this way a little bit, and we recorded credit, because you see the credit is a little to the right of the debit, therefore the account that is going to be credited is to the right of the account that's going to be debited. The second one, we borrowed $5,000. Again, cash goes up and notes payable goes up. That's a liability. Cash right next to the line, debit $5,000. Indent, notes payable, credit $5,000. We have an equal debit and equal credit. Sierra purchased equipment for $5,000. This time equipment goes up, cash goes down. So equipment is the account debited. Close to the line, then we move in like that, and we record cash, $5,000. Well, that is journalizing. Now the steps in recording the process, after we journalize, we post to what's called the ledger. The ledger is just a group of accounts maintained by the company. The asset accounts, we would have a ledger card for cash. We'd have one for supplies, one for land, one for equipment. For the liability accounts, we'd have a separate ledger card for notes payable, accounts payable, salaries payable, interest payable. In the shareholders' equity section, we would have an account for revenue, expenses, common stock, retained earnings, and dividends. Now this is how the ledger works. We first of all give a number to each one of these accounts, list of accounts. The asset accounts, we will give them numbers in the 100 to 200. Liability accounts, 200 to 3. Stockholder accounts, 3 to 4. Revenue accounts, 500. Expense accounts, 600. This is what a ledger card looks like. We post. Here in the journal, we have the journal page 1. The date is October 1st. This transaction affected 2 accounts. Cash went up $10,000. Well, we go to the general ledger and we pull out the ledger card for cash. It number 101. We put in the date, October 1st. We say owner invested, debit. It came from journal page 1. Debit 10,000, and we had no balance before, so now we have a 10,000 debit balance. Now we've posted cash. So what we do is we put the reference here, 101. That refers to the ledger card 101. Okay, so that's the steps in recording the process. Review question, posting. Normally occurs before journalizing? No, you have to journalize first. Transfers ledger accounts to journal, it's journal to ledger. C is an optional step. No, it's not optional, you must do it. D, transfers journal entries to the ledger cards. So here's the recording process. We just did cash and common stock. Now we're looking at the ledger cards as if they're T accounts, not like they really are. We're just visualizing them, seeing them as T accounts. So you see cash, debit, we put it on the debit side of cash. Common stock, credit, went up. we put it on the credit side of common stock. Let's take the next journal entry. October 1st, Sierra borrows cash 5,000 by signing a notes payable. All right, what happens? Cash goes up 5,000 and notes payable goes up 5,000. So we're in balance. There's my journal entry. October 1st, debit cash 5,000, credit notes payable 5,000. Now I post it, the last step. I take the cash, which at 5,000, now recall it already went up 10. I add another 5, debit cash 5, and I credit notes payable 5 in the posting. Now, whoops, I'm sorry. Event number 3. Sierra used 5,000 cash to purchase equipment. The asset equipment is increased 5,000 and cash is decreased 5,000. We're still in balance because we're on both sides of this equal sign. Okay, negative and positive balance each other out. A debit increases assets, so I debit equipment. Debit is always first. Debit the equipment, 5,000, credit the cash, 5,000. Now, if I want to post the cash, you see it's on the credit side here. I simply put it on the credit side of cash, which decreases cash. And equipment went up, so I debit equipment. And that's how I post it. I basically do this journal entry, and then whatever I wrote in the journal entry, I post to the ledger. I said, go to equipment account and debit it 5,000. I said, go to cash account and credit it 5,000. So on October 2nd, we received 1,200 cash advance from a client. Now remember, this is unearned revenue. But our journal entry, of course, cash goes up. It's on this side, plus 1,200. Liabilities went up on this side, plus 1,200. My journal entry, debit cash. Debit's always first. Then credit unearned service revenue, which is a liability account, you recall. Now, when I go to post it, I say, okay, it said debit cash. I go to the cash account, pull it out, say October 2nd, down here, and I debit it, just like the journal said, 1,200. And it says credit unearned service revenue, so I go to unearned service revenue, I pull the card out, and I credit it, 1,200. That's all I do. So for each transaction, that's what you do. You analyze the transaction. We received 10,000 in cash from Copa Company for guide services provided. Okay. Our cash goes up 10,000 and our equity service revenue goes up 10,000. My journal entry, debit cash, credit revenue. You remember, you always credit revenue. Receive cash for services. Post that to my ledger now. I go to the cash account and I put in a debit of 10,000. And it says now go to your revenue account and put in a credit of 10,000. And that completes the journalizing and posting of that transaction. Another transaction, we paid office rent. Well, cash goes down 9,000 and the shareholders' equity goes down because expenses, when they go up, they decrease your shareholders' equity. So the debit is always first. Debit rent expense. Anytime there's an expense, it's always debit. 900. Credit cash. Now, to post that, I go right here, credit cash. And the debit simply to rent expense. So I do whatever I write in the journal. I make sure the journal has equal debits, equal credits. My transaction is correct. I post to the ledger. October 4th, paid 600 for prepaid insurance. Both sides of the the equation. Cash goes down, insurance goes up, both are assets, so we're still in balance. The debit here is prepaid insurance, 600. The credit is cash. Post the cash, credit 600, post prepaid insurance, debit 600. And that's how we keep going. Event 8, October 5th. I purchased 3 months supplies. So supplies is an asset, but I didn't pay for it. I'm going to pay for it later. So my accounts payable goes up. My cash did not go down, but my accounts payable goes up. Debit supplies, credit accounts payable because it goes up. Remember, liabilities increase on the right-hand side. I go to my account, supplies, debit 2,500. I go to accounts payable, credit 2,500. So there you have the recording process. Additional transactions that happen. Well, first of all, you have to determine if it's a transaction. October 9th, Sierra hired 4 employees to begin work October 15th. Nothing, no exchanges happen here. We just hire them. We agree that they will pay them $500 a month for 5 days a week. First payment will be October 26th, but this is October 9th. The transaction has not happened. Nothing has happened here. We're promising to pay October 26th. But this is October 9th, or we signed an agreement October 15th. You remember, a transaction is something that has had to take place that affects assets, liabilities, or the owner's equity. The recording process illustrated. First of all, event 10, October 20th now, 500 cash dividend to stockholders. Okay, our cash goes down, and our shareholders' equity goes down because we are paying the money out to the shareholders. Debit, dividends, 500. Credit, cash. Well, we posted the cash a number of times. You know, you just post there. Dividends, which decreases retained earnings. A decrease in retained earnings is on the left-hand side. And so we are equal, debit and credit. Event number 11, October 26th, a day that lives in infamy, happens to be my birthday. Sierra paid employee salaries of $4,000 in cash. My cash goes down, and my shareholders' equity goes down because an expense reduces shareholders' equity. October 26th, a very important day. Debit, salaries expense, $4,000. Credit, cash. Well, again, credit to cash decreases cash, so it goes on the right-hand side of cash. Expenses always are on the left-hand side. An expense decreases owner's equity. A decrease in owner's equity is on the left-hand side. That's why expenses are always on the left-hand side. So there you have it. Here's your journal with all those journal entries that we have just recorded and we have posted to the ledger. Now, here's what our ledger looks like. We add up the debits in cash and we subtract the credits, and we have a debit balance of $15,200. We have supplies, $2,500, prepaid insurance, $600, equipment, $5,000, notes payable. Notice we have left-hand accounts here, right-hand accounts. Right-hand accounts here, left-hand account. Right-hand account, sales revenue is always right-hand. All the expenses are left-hand. Are we in balance? Well, if the lefts equal the rights, of course we are in balance. And that's what we do. We take, the final thing is we take a trial balance. We simply list the accounts and their balances. And we have 2 columns, a debit column and a credit column. So this is the trial balance at the end of business, October 31st, 2012. Cash had a debit balance of $15,200. Supplies, $2,500. Insurance had a debit balance of $600. Equipment, you see, these are all asset accounts. Notes payable had a credit balance, $5,000. Unearned accounts payable, $2,500. Unearned service revenue, remember that's a liability account, not a revenue account. These are all liability accounts. Here's the shareholders' equity account, common stock, with the shareholders have put in, minus the dividends that we paid them, so it reduces the common stock, that's why it's on the left-hand side. Add the revenue that we have earned in this accounting period to the shareholders' equity section, that's why it's on the right. Deduct the expenses, and trial balance is simply a listing. If my debit accounts, which total $28,700, equal my credit accounts, $28,700, then I can be reasonably assured that everything is in balance, and I have not disrupted that initial balance sheet equation, assets equal liabilities plus owner's equity. And that concludes chapter 3. Thank you.